Do you hear USDA and think of farms or maybe farmland, or isn't that what was on the steak package that I just bought for dinner? While that may be true, the reality is that is not the entire picture. If you ask Jordan Blanchard, he sees hotels, industrial projects and cold storage, rural economic development. What about workforce housing and maybe $15+ million capital stacks that most conventional lenders wouldn't even think about touching? If you're an operator, a developer, or an investor looking to add another arrow to the quiver, this episode will help you understand when USDA financing may create a real edge and when the complexity might not be worth it. We're breaking it all down today with Jordan. Jordan, welcome to the show, my friend. I'm excited to have you here today.
Thank you, Kevin. It's going to be a great conversation.
Yeah, I'm looking forward to it. This is one of those topics, that I'm somewhat of a neophyte with, and so definitely excited to learn quite a bit more. Not just about your background, but also, USDA financing and kind of your expertise, an area that you've been in for decades now. So I guess maybe to kick this off, would love to maybe get a little bit more of a backstory. Most people, I wouldn't say wake up just one day and decide to become a USDA lending expert. So why don't you take us back in time a little bit and, talk to us about how you got into this niche and what really drew you to, government-backed lending?
Sure. So I look at it like a pyramid. So I went to school to major in business administration, and then the next rung up was finance. And then from there, I got a bank job working at Wells Fargo. And then I discovered the world of the Small Business Administration, so SBA loans. And I'm a deal junkie. So the programs that allow me to do more deals, I kind of gravitate towards. But SBA was my stock and trade for about 25 years or so. And for the last 10 years, it's been USDA. The evolution was I was working at a bank, a big SBA lender, and they said, we've discovered this thing called USDA. Would you like to go ahead and start a department and run that? And I said, sure. Didn't really realize it, but I was kind of bored with the SBA product. And then within about 3 years, we became the largest USDA lender and, left the bank, started a non-bank lender, and here we are. And I'm happy to go into any more detail that you'd like to hear.
Yeah, no, that's great. Just for some general context, what is the on an annual basis, like how many USDA loans are actually made? Is it in the multi-billions? I'm curious.
It's a great question. So I'll start first with SBA. The SBA financing market is about $50 billion across the country. Okay. For the USDA programs, and there's multiple. The amount is closer to about $1 billion this year. A couple of years past, it was 2 to 3, but this year it's about $1 billion. That's one reason so few people, especially investors, really know about the USDA product. It's just not as prevalent.
So let's talk about the product itself. Maybe a 101 lesson. I will make the assumption that a large majority of the folks listening, just given the context you just shared, while they probably have heard of a USDA loan, a lot haven't ever used one. They're not familiar with it, and so maybe let's start with the basics. What exactly is USDA lending, and maybe how does it differ from that of conventional lending?
USDA. Let me just start there because I'll tell you what it is not. The programs we work on, and there's various programs within the USDA. So we work on programs that are under the umbrella called USDA 1RD, stands for One Rural Development. This is the economic development financing division for the USDA. They also have a farm lending division. They also have multifamily, rural residential. They have a lot of other programs. Our subset is economic development. The reason somebody might be interested in a USDA loan or an SBA loan is more flexible underwriting. Either that's higher leverage, lower down payment, or the ability to lend on projections. So both programs share that. So if you have a transaction that doesn't quite qualify for conventional, then you're going to look for the assistance of a government guaranteed loan from a government guaranteed lender. As far as what is the difference between conventional, number one, conventional is usually lower rates and terms because they're better credits, but conventional typically will require a higher down payment, maybe 30 to 40%, depending upon the property type and the state of the credit. A USDA loan will typically be able to go to 80 or 85%. An SBA loan can often get up to 90%. So it depends upon the level of flexibility that you need. But just understand, if you're a small business owner or an investor, you're going to be paying for that flexibility.
Okay. Yeah. So maybe let's talk about that a little bit. So let's assume that I've got a project that maybe qualifies for both a conventional loan and potentially a USDA loan. I guess, how do we think about the trade-offs there?
So if it's 5 million and under, I encourage clients to find an SBA lender. It's faster for one important reason, which I'll delve into in just a minute. And it's a little bit easier to qualify for. So as far as being faster, as a USDA lender, we have to submit our transactions to the USDA. So we have to take the time that it's going to take, or we have to add the time it's going to take for the USDA to review a package. So for our process, it's probably 4 to 6 months, whereas in the world of the SBA, it's usually 3 to 4 months because they have what's known as delegated authority. They can approve a loan on behalf of the SBA. So 5 million and under, generally you should go talk to an SBA lender. 5 to 15, you need to compare the two programs, SBA to USDA. When you get to be about $15 million in debt, SBA really is not a good fit. It breaks at about that level. And with the USDA, our maximum loan amounts are $25 million for the general purpose program, but we have a lot more flexibility to add in other debt on top of the USDA loan. So commercial PACE, which we'll talk about later, new market tax credits, TIF financing, which is local bond authority financing. The SBA can't touch any of those. So in the world of the USDA, $15 to $50 to $75 million in debt is kind of our domain. Smaller projects are better off with SBA.
Got it. So you caught my attention with the the USDA, the 4 to 6 month processing time. What's the reasoning behind that? Is that just the inefficiencies of our American government, or are there some other nuance associated with it?
The main one is the USDA doesn't process applications in a parallel fashion. So it's very linear. They expect the lender to do 100% of the work that's necessary to actually close a loan, and then that's when they invite in the application. So to close a transaction is generally 90 days. But if that's the starting point for the USDA, then we have to add on the time for the USDA. So that's one reason. And then honestly, the other reason is the terms are not as attractive as conventional debt, is what we spoke about earlier. So we end up getting a lot of construction. A construction project is just going to take longer because we're going to need final cost breakdowns, an appraisal based upon the final designs. And it takes the client a long time to deliver what they need to deliver, which extends the processing time.
Got it. So would love to maybe delve into the maybe some of the bigger misconceptions again. As I had mentioned in the beginning, I'm just not very knowledgeable on this topic at all. When I think of what immediately comes to mind when I think of a USDA loan, I think of farmland, I think of rural. Those are the terms that come to mind. And so, but maybe expand our minds a little bit as to maybe some of the use cases for this type of product. And it's not just for farms. It's not just for necessarily small little rural towns per se.
We're actually, in our programs, again called USDA 1RD, we're prevented from funding farms or ranches. And the reason is USDA says, look, we have farms and ranch programs over here. Stay away from that. And what we need you to focus on is rural economic development. As far as the types of projects, it's quite varied. The USDA has about 10 types of projects they don't want you to consider. So golf courses, racetracks, other lending operations. So that generally eliminates pawn shops, financing of films, what have you. But the entire rest of the universe is available to us. So we do a lot of hospitality. We could do medical. We could do retail, non-owner occupied, owner occupied. We've done mines. We've done sand terminals for fracking. It just is incredibly varied as to what we can do. There's not really a limit. So that's kind of one part of your question. The other part of your question, and a misconception, is that it has to be in a town of 1,000 people. It's not the case. So in general, it is a location that is in a township or a census tract of 50,000 or less, not contiguous with a more populated area, based upon the last census. Well, the last census was 2020. We're in 2026 but now. So you could have a town that was 40 or close to 50,000 that's now 70 or 80. So if you're an investor and you see the path of growth from rural to more urbanized, you may want to develop in that path, and a USDA loan can often be a tool for you to be able to do that.
Got it. Do you find that the majority of your clients are these new projects, are these new development projects, or is it a fair mix between new development and maybe existing refinances or maybe acquisitions?
Great question. So before I answer the kind of the product mix, let me just first say that again, I say rural economic development, and I mean kind of job producing, what have you. Mm-hmm. What the USDA does not allow us to finance with these products is anything residential or multifamily. Again, they have their own multifamily program. They have their own residential program. So they don't want us touching those. So when you say development, it wouldn't be tract development, but it might be the development of a hotel as an example. The biggest use of funds is for construction. The second largest is for refinance, and the last is for purchases. And the reason purchases are last is because a purchase contract has a definite time for the escrow to have to close. Well, if we have to submit a transaction to the USDA, we don't control that process. So how in the world can we be assured that we can close a transaction on a purchase? We see very few purchases. See a fair amount of refinances, mostly construction.
In the beginning, you mentioned maybe some of the bigger benefits of this type of lending program. You mentioned higher leverage points. Is longer amortization terms? Are they typically longer than have a traditional conventional loan as well?
So there's two benefits there. So number one is longer terms that are fully amortizing. So a conventional loan usually has a bullet it's a balloon in 5 or 7 or sometimes 10 years. And most investors are okay with that, but what happens if you get 5 years down the road and interest rates are 500 basis points higher than they are right now? Your project may not cash flow. So for me, a fully amortizing loan is a safer bet. So that's one. Two is we'll often build in, especially for construction, 2 years of interest only. Even if it only takes 18 months to build a building, having that extra 6 months of interest only is a benefit, followed by 25 years fully amortizing. So a 27-year loan is a keen benefit in the financing world.
Got it. Fixed rates as well. I'm assuming there's no floaters in there.
It's up to the client to choose what they want. So I would say back to the SBA for their flagship program, 80 to 90% of the loans are written at prime plus some spread, adjusting quarterly. So clearly those clients and those lenders are taking interest rate risk. In our world, we just negotiate with the client. I've had one client who chose a prime deal, and he chose it 3 or 4 years ago, and he's won large. Most clients want some level of fixed rate, so we see a lot of 5-year resets, sometimes a 7-year reset or a 10, or we even have loans on the books that are a full 40-year fix. So we can do all of the above.
Got it. I know you mentioned the government they have their own multifamily programs, but so we're in the manufactured housing space. Do we fall in that same bucket, or are there actual USDA programs for manufactured housing communities?
Not yet. So traditional kind of residential where people live full time, that will never come down the pike for the types of loans that we do. However, we are working with USDA and Congress to allow workforce housing. I just read a Wall Street Journal article today that data center builds in Montana are requiring something like 6,000 persons to come there, and they need temporary housing for the time that it's going to take to build a data center. That's what we'd like to be able to finance because that's clearly rural economic development. But as of right now, unless that is going to be used for a commercial purpose, not to house people, that's not something that we could finance. Understood.
So talking about the capital stack side of things, obviously that's an important component of any, investment. And so you'd reference there's multiple other options of additional capital sources that can be stacked in and above, USDA loan. So maybe talk to me about that a little bit. What are some of the different programs out there? when might they be relevant to consider and put in place? And maybe even, I love case studies. I love examples of when one of these scenarios actually comes to light. And so maybe give us a real world example of a recent deal, maybe that you've done where you've added some additional lending sources on top of the existing loan.
So I'll kind of rank them in terms of popularity, and there's three. So the first is commercial PACE. PACE stands for Property Assessed Clean Energy. And for the benefit of your listeners, I'll just explain that PACE financing is self-tax assessment. So if I have a building that's going to cost $10 million and the lender says I can go to $6 million and I have $2 million to put down, then I could get a self-tax assessment. So what that means is I go to our affiliate, in our case, and say, will you give me $2 million so I could use towards the construction of my building? And then the financier says yes, and then goes to the county and says, add this to that person's property tax rolls. The county collects it, pays back the financier. The benefits of PACE are that it's non-recourse because it's a tax assessment. It's not a debt to an individual or a business. So it's non-recourse. It's off balance sheet, depending upon how your accountant wants to treat it. That's an extremely popular program. So that's number one. The best use case I have there is we funded a hotel development project in Hyde Park next to the Culinary Institute of America. It was about a $50 million project. An SBA loan generally caps out at $25 million. Well, the client didn't want to have to put up 50% in equity, so PACE usually allows for 20 to 30% of tax increment financing, not to be confused with a TIF bond, which I'll talk about in a little bit. And so, maybe that was another 15 million and the borrower put down 10 or 20%. So that's how we're able to close the gap on these larger transactions when the USDA loan gets capped out. Got any questions there on PACE?
Yeah, no, I do. I mean, are there particular types of projects that's a better use for? Like I think the one you just referenced there was a hotel or some type of resort. Is that the ideal use case, or are there other projects that might fit within that bucket as well?
So PACE is intended to be an incentive for energy efficient improvements. So if you're going to build a building, maybe you put in energy efficient windows or energy efficient roof or energy efficient HVAC. So our affiliate will get a budget and says that qualifies as energy efficient, that qualifies as energy efficient. It's no more than code. It's not like a LEED certified where the construction cost is, orders of magnitude higher. It's just, most developers will choose energy efficiency over not energy efficient because of the long-term savings. So number one, it has to be new construction because you have to build in energy efficiency. If you buy a building, there's no new energy efficiency going into that. So that's number one. And then number two, currently about 38 states offer commercial PACE, and not every county in every state that authorizes it is willing to collect the taxes. So it's very much location dependent as to whether or not you can get PACE financing. And then again, it's got to be new construction only.
Okay. No, that was helpful. I appreciate that. You mentioned there's multiple other types as well.
Yep. So the second most popular is a local bond issuance. So, and this is on larger projects. So you might see a project that is $70 or $80 million, and the developer, and this is very common in Utah, and I think they call it a PID, and I don't know what that stands for, but it's gives the developer the ability. It's almost like PACE. It gives the developer the ability to borrow against future revenues. So if I need a parking garage, then the local or the state bonding authority will sponsor the developer issuing a bond. So on a $70 million deal, I might be able to get $20 million to build that parking garage, and the bond is going to get repaid from the revenue from that parking garage. The local authority or municipality does not take any financing risk. It's only the investor's only relying upon the revenue. So again, depending upon the state that you're operating in and the size of the project, it needs to be a larger project. That kind of bond financing is also very popular.
Okay.
Let me go
Got it.
just go to the last one. There's more, but the one that's really up and coming at this point is what's called new market tax credits. They don't much like hospitality. They want job producing, job creating entities, and they're going to have a focus on states. They also have a focus on rural locations as well. But new market tax credit is a benefit from the U.S. Treasury where they will give an intermediary the benefit to sell a credit from an investor to something like U.S. Bank. U.S. Bank, maybe they pay 80 cents on the dollar for $1 worth of credit. So they get a nice pop, immediate tax savings, good rate of return. That's 80 cents of every dollar that can go into the project. And then in that particular case, there's a 7-year make whole, or not make whole, but a 7-year gestation period. At the end of 7 years, that is forgiven. So if you are a developer and you can get 20 or 30% of your project financed by a third-party source that is then going to forgive that loan, that's a home run. Now, they're not easy to get. There's a lot of demand for them, and it has to be the right project in the right location. But when it works, it's a great addition for any developer.
Maybe starting back from the beginning, if I'm out there, an investor, got an exciting project. I mean, is there a simple address search I can do on the USDA website that will help me identify whether or not I'm even in a qualifying zone to where it makes sense for maybe us to have a conversation with you, Jordan, about maybe a potential loan?
If you just search USDA eligibility, a map will pop up or a link will pop up, and it'll open up a mapping system. And then from there, you choose which program. So as I said earlier, there might be multifamily or there might be residential. All of those are on the same map. So you have to choose business programs. You enter your address, and then it will tell you graphically, like via a map in colors, if you're eligible. So that is the easy way to find it. It's also critical. Nobody should assume that because they believe they're in a town of 50,000 or less, they're automatically eligible. If you're contiguous with a more populated area, you may not be. Conversely, we did a hotel project on Kent Island off of Maryland. And, that's a very populated area. But the fact that there was a separation with the ocean channel there, the USDA said that it's separate and distinct, and therefore it qualified as rural. So the map is king. Only ever believe the map, not anyone else or what I tell you or anybody tells you. The map has to show that it's eligible.
Are there any common mistakes that you see maybe investors make when going down the application process? Maybe common mistakes or maybe common reasons why they might get declined, and any advice you might have to better set them up for success if they intend to go down this route?
One of the biggest mistakes that borrowers might make is believing that this is an easy program to qualify for. What we often hear is you're getting a partial guarantee from the USDA, therefore you should want to do every project. And the answer is absolutely not. We are stewards of the government's money, number one. And number two, they hold us responsible. And if our default rate was too high, they would banish us from the program. So you still have to qualify. It's still commercial debt. We deal in very large transaction amounts. And so we're going to do our complete due diligence. So that's the very first thing. Number two, you have to be prepared. You should put together not a novel of a business plan, but we need to see what the vision of the project is. We want to see a capital stack. We want to see management histories because in our case, we're going to focus on folks that have direct industry ownership experience. So if you want to build a hotel, it's not good enough that you were the manager at the local Days Inn and now you want to build a $30 million project. That is not going to qualify. So we need strong management ability. We also want to see folks that have the ability to raise money. We want to understand where they're going to be able to raise more money when something goes wrong, because something always goes wrong. So having that sufficient equity is critical. We and every other USDA lender has learned the hard lesson that if folks go in undercapitalized or don't have any ability to raise additional debt, there's going to be a stress point.
Talk to me about the future. I mean, what do you, anything that you're excited about, as it relates to, to this lending platform? I mean, any big policy changes that you see coming down the pike, that you're excited about, big opportunity coming down, that you think, folks should know about?
I'm part of a trade group, and the trade group is constantly interacting with the USDA and Congress. And we think that there is support for larger transactions or larger loan amounts. So currently we're capped at 25 million, and we think that 50 million or maybe even 100 million might be an option. If not for one project, at least maybe per borrowing group. So we think that's interesting. We also believe that the USDA wants to see a more traditional multifamily program financed with our product, including workforce housing, which we talked about earlier. So currently, the USDA multifamily program is more kind of low income, low rent controlled. A lot of developers don't want to do that. The changes that the USDA is thinking about for our program would allow us to just do traditional multifamily, except that it has to be in a rural area. Our affiliate is a housing and urban development licensed lender. So if we pair that level of expertise with our USDA knowledge and expertise, that would be a very exciting combination for our company.
Yeah, no, it sounds like it. No, that'd be great. That'd be great. Well, so Jordan, a lot of what we talked about is originating of a new loan, but would love to get a better understanding about maybe the aftermath. We all hope and pray that every deal that we do, it does great, exceeds expectations, but we all know that's not the world that we live in. So, what have you seen? What really breaks some of these deals, post closing? Maybe speak to not just maybe the business model that broke, but ultimately what occurs then after the fact if one of these loans goes into default. What's the process like? And maybe how does it differ from that of what would happen with a traditional conventional loan?
Yeah, so like I said earlier, these are inherently riskier transactions. And one of the main reasons for the higher risk is the fact that we're lending on projections versus historical cash flow. So when you go to a conventional lender, they'll collect your tax returns and financial statements, and they'll see that last year that you made enough money to pay for whatever loan. It's just traditional debt, getting a car loan, getting a home loan, anything else. That's a big benefit to be able to see that somebody has already sufficient income to repay the loan. In our world, we're dealing with expansions or startups, and therefore we're having to lend on projections. So the client will submit a business plan, and we'll go through that and see if it makes sense. We require what's called a feasibility study. So the client is responsible for hiring a third party to validate the assumptions. So we do as much underwriting as possible and due diligence and fact checking as possible up front. But once a project opens, you just never know where the project may go or the reasons why it may fail. So in our case, we have a project for a food ingredient manufacturer who was depending upon the FDA, and the FDA just took so long that it really stressed the cash flows. We had another project where we had a non-owner-occupied cold storage transaction that partnered with farmers to store crops, and the farmers couldn't make the sale. I mean, it sounded good on paper, but it just didn't work. We have another project, a hotel at the Great Smoky Mountains, right at the entrance. You'd think if it's location, how can this thing fail? But they weren't able to get the bookings, and so they're having issues. So the reasons are wide and varied, but it comes down to one thing: when you lend on projected incomes, projections may not work out. You asked what happens if there is a delinquency. So the number one piece of advice I would give to any borrower: be forthright, be communicative. If you tell us early on, we can get ahead of the issue. I'll give you a really good real world example. If somebody comes to us and says, I foresee cash flow struggles starting in 2 or 3 months, we can then work with the USDA and offer that client a deferment or possibly an interest-only structure to allow them to work it out. If they are afraid to talk to the lender and they become delinquent USDA will not consider any sort of rework of a loan while a loan is in delinquency. If you didn't have enough to pay that loan going into the delinquency, you're probably not going to have enough to get it caught up to where you could get a workout. So early communication with the lender is critical. We're not a parent. We're not going to scold you. We're going to try to work with you as a partner. I'll leave you with just with one thing because I think it's so insightful and kind of humorous. The last bank I worked at, they had the 5 Ds as to why transactions fail. So death is one that happens, unfortunately, sometimes. Divorce, drugs, it happens more than you would think, depression, and then dumbass. Some combination of those will cover about 90% of defaulted transactions.
Dumbass. I like the last one there. That's classic. And then I'm assuming all these loans, they have personal guarantees, right? I mean, so there's obviously, in the event it goes into default and the loan can't be rectified, there's the typical recourse that one might expect if you're signing your name and your personal assets on the line, correct?
Not necessarily. So it depends upon how it's structured. So in the world of the SBA, they will not stop until they get to a warm body to personally guarantee. In the world of the USDA, we can consider the total picture. So somebody might have sales contracts and a revenue stream, or they're expanding, but their current business allows for sufficient income to repay the debt. Or in many cases, we do renewable energy transactions and selling to the power company. It's a different form of guaranteed revenue. So in those situations, a personal guarantee is not required. These days, here's the way the USDA looks at it. And in the regulations, they say a personal guarantee is required. That's the base case. And then the lender must justify why a personal guarantee is not being taken. So we have to build a very strong case for the USDA to consider not requiring a personal guarantee. One reason might be there's no majority owner. You have 10 owners, they each own 10%. We're probably not going to get a personal guarantee from one person in that scenario.
No, that makes sense and very helpful. Thank you, Jordan. I'd love to move on to a segment that's kind of new. Haven't done it. Maybe years ago, I used to do it kind of like a rapid fire closing. Wrap it up. 5 quick questions. Five quick answers on your part, and then we'll look to round this out. So I think this has been incredibly valuable. But so if you're ready for it, let's roll into the rapid fire round. You good?
I love this type of interaction for sure.
Okay. How about first one? Most underrated USDA loan feature.
The ability to lend on projected income.
Largest loan that you've ever worked on.
Largest loan, not USDA, but today we're closing $185 million first lien on a new construction hotel in Hawaii. We think that's pretty cool.
Wow, that's a big one. That's a monster. Good for you. Congrats. How about asset class that you're most excited about? You made reference to maybe hopefully some of the changes that might be coming down the pike with multifamily, things like that. But just generally speaking, an asset class that you're most excited about as it relates to this program.
Well, what I'd like to see more of, and that I think it would be of interest to your listeners, is non-owner-occupied investor properties, where somebody builds a building and then they lease it to a third party. We really like that. We think that's a little bit safer because we have the owner to rely upon and as a backstop to whatever the tenants are. If we have multi-tenant, then we have many tenants that are responsible for making the payment. So we like those. That is probably the most underutilized aspect of the USDA program. I don't know why. For the Small Business Administration programs, it has to be owner-occupied, anywhere from 51 to 60%. Our programs do not. You could build a building and lease it to the post office or FedEx or Amazon or anything like that, or just a retail strip center with dentists and a Chinese restaurant and a dry cleaner. It all works.
How about one thing that every real estate investor should know about USDA lending?
Again, I'd go back to the capital stacking because in today's world, it's hard to get a single source. So if you go to somebody who's knowledgeable about the various sources, we don't offer new market tax credit investing, but we sure are knowledgeable about it, as well as the various other types of credits, investment tax credit, historic tax credit, pairing commercial pace. So the ability to put these puzzle pieces together, I think, is the most advantageous aspect of going with a very experienced lender.
No, fantastic. And then the last one here, what should listeners do first? Do they think that they've got a qualifying project? Pick up the phone, call you, I'm assuming, but you tell me.
They could do that. So first, start with a lender. Don't start with the USDA. The bank is the customer is the client of the lender or the bank, and then the lender or the bank is the client to the USDA. So many people start with calling the USDA. All they're going to do is give the old three names and choose. So don't go that route. But clearly, if somebody were to search Excalibur Real Capital or the like, they would get a hold of somebody in our team. And we pride ourselves on being quasi-consultants. Somebody calls us and says, I have this dream. And we say, great, here's kind of the outline and the parameters that you need to know. We'll paint the target so that the developer can put at least the parts of the puzzle that they're responsible together.
That's fantastic. No, Jordan, this has been a great conversation. I appreciate you coming on. Really insightful. Again, this is a topic that I just don't have much background in. So you definitely opened my eyes to a lot of things I did not already know. So appreciate you coming on and sharing your knowledge with us here today. So for those that have an interest in learning more, maybe reaching out to you and your group, where's the best place to contact you?
They can find us on LinkedIn. We have a pretty large presence there. They could see a lot of our transactions that we funded over the years. So that's a good place to learn. Our marketing group does a great job of putting educational material out on LinkedIn as well. Our website, I'll just quickly note my email address. It's Jordan B, JORDANB at xrcusda.com. So XRC stands for Excalibur Real Capital. So somebody sends me an email. I'll often host a first call if somebody wants to apply for a loan. Then we have loan originators that I would introduce at that point.
Alrighty, that sounds good, and we'll get that in the show notes. And again, Jordan, appreciate you coming on the show, and to everyone listening here, I hope today's conversation just opened your eyes, an open mind to a financing tool that I think a lot of investors overlook or just don't know too much about, like myself. And I think in today's world, I think one of the biggest advantages in real estate isn't necessarily finding better deals. It's really having access to better capital solutions and alternate capital solutions. And so, again, as you've heard today, USDA financing, it might be able to create opportunities that simply might not have been possible through conventional means. And so, with that, if you guys enjoyed today's episode, please do take a moment, subscribe to the show, leave a rating and review, and share it with someone in your network who could benefit from hearing it. And as always, I encourage you to continue learning, continue growing, and most importantly, continue investing with intention. So with that, we'll see you guys on the next episode. You take care.